This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Big week for both stocks and oil. What drove it, and will the rally continue into year end?
Dumping coal, the two largest public pension funds in the country are selling their holdings in this already beaten down sector.
Market Monitor, our guest tonight, has a list of stocks he says will rise 10% over the next year. All that and more tonight on Nightly Business Report for Friday, October 9th. Good evening, everyone. I'm Sue Herrera.
And I'm Tyler Matheson, coming to you tonight from rainy New York City. What a week it was, folks, for stocks. The S&P had its best week, believe it or not, of the year. The blue chip Dow index up 6 sessions in a row, its longest win streak since last December. And it wasn't just equities that saw strength. Oil logged a 9% gain during the past 5 trading sessions. Today, the Dow Jones Industrial Average rose 33 points to close at 17,084. The Nasdaq added 19 and the S&P 500 added a point. Not much, but it still counts as a win. And look at the numbers for the week. The Dow and S&P 500 both with gains of more than 3%. Mary Thompson with more now on the big week for stocks.
Well, oil activists and expectations the central bank will keep from raising interest rates this year, all helping to fuel strong gains on Wall Street this week. Notes from the Federal Reserve's last meeting suggest policymakers remain dovish, concerned about the international markets and a lack of U.S. inflation. All of this spurring a move into riskier assets like stocks as well as commodities. Leading the commodities space, oil, it was up almost 9% this week as it traded above but failed to close above that $50 a barrel mark. The rally spurring big gains in energy stocks, though, the week's best performing sector. Activist investor Nelson Peltz taking a $2.5 billion stake in General Electric, the Dow's second best performing stock. And DuPont, another Peltz target, rising over 14% after CEO Ellen Kullman said she's retiring next week. And speaking of next week, big bank earnings from General Electric, inflation data, numbers on retail sales, as well as industrial production, all in focus. From the New York Stock Exchange, I'm Mary Thompson.
More now on oil, which did rally this week, but today failed to settle above $50 a barrel. Domestic crude prices finished at $49.63, a gain of 20 cents. Jackie DeAngelis tells us why it's more than just supply and demand that's driving prices higher.
Crude oil prices gushing higher, finishing the week with a little less than a 10% gain. The catalyst? Tensions in the Middle East, concerns over Russia's involvement in Syria and what it means for the region. Is Russia aligning itself with Iran? And could Saudi Arabia plan a counterattack? If that happens, could the Saudis and the Russians really sit down to discuss oil prices?
That's the only thing going for this market, and that's certainly a big worry. It's a big concern of mine, and there's a lot of room for error, and those errant missiles yesterday just highlight how scary this is. But the oil market does a good job after a while of digesting these sorts of situations, and I think that's going to happen again here as we get used to these misfires and other misactions by the Russians in Syria that will allow the fundamentals again just to simply overwhelm things.
And the fundamental story hasn't changed. U.S. production is off its 9.6 million barrel per day July peak, but declines are slow, now slightly more than 9 million barrels per day. Investors wondering, when will these numbers finally fall in a meaningful way? Also, seasonality. This is the time of year that crude prices usually decline.
You're going to see huge increases in U.S. crude oil inventories over the next few weeks because of this low refinery operating rate. And that's really, I think, going to catch some of the people by surprise and see what we did last year.
The million-dollar question, where do oil prices go from here? Goldman Sachs out just the other day, reiterating its bearish call, saying that oil will stay lower for longer. For Nightly Business Report, I'm Jackie DeAngelis.
So will the rally in the oil and stock markets carry through to the end of the year? Let's find out from Joe Duran, the CEO of United Capital. Joe, welcome back. Let's start with stocks. The last 2 weeks have been very favorable for equities. Do you think it can continue?
Oh, it can definitely continue, but I think you should expect some kind of give back. We've had a very strong recovery. We're now slightly overbought. And so when you have these very big whipsaws, not unusual to go back and have a retest. Probably won't go back as low as we've been, but you should expect this to be a lot more volatile over the next year than we've been over the prior the last 5 or 6 years where it's been remarkably calm.
So, Joe, what about oil? You know, a 10% move after being depressed for so long. Are we putting in a bottom here, or do you expect this move to continue?
No, I don't think that it's enough given the magnitude of decline. Remember, we were over $100 not that long ago. So it's really just noise. I do think we're searching for a bottom, and we've fairly safely established at 42 to 48 is sort of where we're at. And candidly, as long as we stay in that range, we don't go below 40, stay above 42, and the dollar kind of stays in a range, then a lot of the detractions to the market have disappeared. And so it's very constructive if we can just stay in a predictable range that's not, a 50% decline from here like we've already experienced. So I think we've found a base. It will continue to be noisy. There's not a good reason for it to go down a lot. There's also not a good reason for it to go up a lot.
Stability, basically, is what you're saying there. Let's switch back to equities now. Earnings get really into full swing next week. A lot of the financials, some of the other big blue chips. Has the forecast for earnings for the third quarter is pretty dour. Has the market already discounted that?
Yes, it definitely has. And remember, we've already marked in a third consecutive revenue decline into the market. It's priced in. I think what you're seeing now is actually people start, if oil can continue the recovery we've had, will start to amend their forecasts up. What's interesting is a lot of the forecast for earnings decline is really led by commodities. And if we get any stabilization, that's going to be fantastic. And so I think you've seen the worst of it. It's really disappointing to not see more revenue growth on a whole. But what you'll see is that a lot of this is priced in. A lot of the companies that are going to warn have warned already. And so I think most of the noise is out of it. My biggest concern, candidly, is what happens in December if we get into another debate about the ceiling, the debt ceiling in the U.S. That's really the biggest concern I have right now.
We have to leave it there. Joe, thank you very much. Have a great weekend. Joe Duran with United Capital.
Well, speaking of oil, the oil market is also watching developments in Washington. The House of Representatives today voted to lift the 40-year-old ban on oil exports, which was first put in place after the 1970s Arab oil embargo. The oil industry argues that lifting the ban would create jobs, but the measure faces a much tougher fight in the Senate.
And Sue, a petition in the House of Representatives to revive the Export-Import Bank drew enough signatures to force a vote on the issue. It'll take place later this month. The federal agency provides loans to overseas customers of U.S. companies like Boeing and General Electric. But the measure is likely to stall in the Senate, where the Republican Majority Leader Mitch McConnell is opposed to keeping the bank open.
To some economic news now. Prices for imported goods fell for the third straight month in September, but the decline in import prices of 0.1% was smaller than expected, and that smaller decline could bolster the Federal Reserve's case for raising interest rates. In the past, Fed Chief Janet Yellen has said that import prices have been a major factor in keeping inflation well below the Fed's 2% target. Ty?
Well, the low rate of inflation was just one of the issues the president of the New York Fed discussed today with Steve Liesman. In an exclusive interview, Bill Dudley shared his take on the economy and when the central bank may decide to raise interest rates for the first time in nearly a decade.
Is it likely the Fed could hike rates in October?
Well, I think, the chair has said, and I agree with her, that every meeting's on the table. At the same time, have we seen enough information between September and October to convince us to do in October what we didn't do in September, would be the question I would ask.
And how would you answer that?
I think I'm not going to prejudge what we're going to do at the October meeting. I mean, I think every meeting should be a live meeting where we go into the meeting and assess the evidence and assess how that weighs on our outlook for the economy, both with respect to the labor market and inflation, and then use that as the basis for making a decision about whether it's time to lift off.
Dennis Lockhart said that he still thinks a rate hike is likely this year. Are you in that camp as well?
Based on my forecast, yes, I am. But it's a forecast. And we're going to get a lot of data between now and December. So it's not a commitment. So if I say I think it's likely this year, it doesn't mean that I'm committing to doing it this year. It's just based on my expectation of how the economy is most likely to evolve. There's certainly a risk that the economy evolves in a very different way than I expect, and obviously be totally inappropriate for me to not take that into consideration in terms of what I think is appropriate for monetary policy.
I can't not ask this question. The possibility of a shutdown in Washington and the impact there. Is that something that animates your policy making right now?
I don't think so. I mean, I think, first of all, I would expect cooler heads to prevail. I think it's crazy to talk, even think about not paying the debts that you are obligated to pay over time. Obviously, we have to take the world as it is, though, and if it evolves in some crazy way, which I think would be totally inappropriate, that obviously would factor into our decisions, just like any other development would factor into our decision making.
And as for the labor market and last month's disappointing jobs report, Dudley said it is important not to put too much weight on one report because payroll numbers can be volatile month to month.
Chicago's Fed President Charles Evans also spoke today. In prepared remarks, he said the Federal Reserve should move modestly when it does decide to raise rates, but he declined to say exactly when he would like to see that first rate hike. Ty?
And still ahead, why there was confusion today over the security of those new chip credit cards. A warning from Dow Jones today. The company says it found evidence that hackers have infiltrated its publications, including the Wall Street Journal and Barron's, dating back to 2012. Information from at least 3,500 individuals may have been accessed. Officials from the company said the breach is likely part of a broader campaign involving other companies.
And confusion today over just how secure those new chip credit and debit cards really are. First, the FBI put out a warning about their vulnerabilities, only to take it down later in the day. So Eamon Javers has been following this story for us, and he joins us now from Washington. That certainly is an unusual turn of events.
Yeah, it really is, Sue. This is one of these only in Washington tales that really tells you how this town actually works. Let me walk you through the timeline here. So last night, the FBI put out this alert saying that, by the way, those chip cards, the credit cards that have just been issued to all credit card holders, or most of them here in the United States as of October 1st, are still potentially vulnerable to fraud. And in that alert, they urged people to use what they call chip and PIN technology. That is the chip plus a PIN number that you have to enter. The National Retail Federation, which represents retailers across the country who've all been installing new equipment to deal with these new cards, took that as a victory for their side in a long-running fight that they've had with the banking industry. The Retail Federation said that they'd like to see a higher level of security, not just chip and signature, which is where we actually are with security on credit cards these days, but they'd like to see that whole chip and PIN. And they said the FBI is endorsing their side of this argument. The bankers, though, said, no, wait a second. The FBI might not know exactly what they're talking about here. The bankers contacted the FBI beginning last night, and then this afternoon, the FBI actually took this alert down from their website. They gave us a statement just a little while ago in which they said, we are in the process of reviewing the PSA for clarity. As of this moment, as I sit here right now, that PSA, the alert, has been removed from the FBI's website. We don't know when it's coming back up. We don't know what it's going to say. And we don't know ultimately where the FBI is going to come down in this long-running debate between the retailers and the big banks, Sue.
The story continues. Something
That's right.
that you'll be following for us, I know. Eamon, thank you.
You bet.
Eamon Javers in Washington. Ty?
All right, Sue, California is going to become the first state to divest from coal. The governor signed into law a measure that requires state pension funds to drop all coal investments. And as Hampton Pearson tells us, it's another blow to a sector that is already fallen on hard times.
Legislation signed by California Governor Jerry Brown gives the state's two largest pension funds 2 years to divest their investments in coal companies. Environmentalists say this is an important market signal on climate change.
This is a strong vote of no confidence in the future of fossil fuels. It puts a value on our obligation to protect future generations from the dangers of climate change, and it puts a price tag, if you will, on the dangerous carbon pollution that's driving climate change.
An estimated $100 million is invested in coal mines in pension funds for public employees and teachers. Their total assets top $475 billion. The head of the California Pension Fund says it will begin negotiations with major coal companies about their portfolio holdings. A statement reads in part, climate change represents risk and opportunities for a long-term investor like CalPERS. But pension investment experts say the future benefits for state workers should not be put at risk by the debate over climate change.
And the larger issue for pension funds everywhere is whether politicians should be telling investors how to invest.
Coal has been taking its lumps in the commodities markets lately, down more than 50% in the Dow Jones Coal Index just in the last 6 months. Meanwhile, New York and Massachusetts are considering similar legislation. For Nightly Business Report, I'm Hampton Pearson in Washington.
United Continental predicting sunny skies ahead, and that's where we begin tonight's market focus. The carrier hiking its profit margin forecast for the third quarter. This is partially due to a new credit card agreement for frequent flyers, which the airline says will provide it with extra revenue. Shares rose more than 6.5% to $55.71. American Airlines also rallying today. That company reported a 7% increase in traffic last month, the biggest jump in that metric for the carrier so far this year. Shares were nearly 7% higher to $42.42.
Well, Sue, Johnson & Johnson has begun a clinical trial of its experimental Ebola vaccine in Sierra Leone. There is currently no licensed vaccine for or cure for this deadly disease. The Dow component rose slightly today to 95.37. SolarWinds, a company that makes software that businesses use to manage their data networks, says it is exploring strategic alternatives. The company could pursue a sale. Its market value about $3.5 billion, and the stock soared more than 13% today to $47.49. And EMC saw its shares rise on continued reports of a potential deal with Dell. As we told you last night, Dell could buy the company in what would be the biggest tech tie-up ever. Today, CNBC reports that Dell could offer at least $30 a share for EMC, and shares of EMC up 2.5% today to $27.86. Dell, as you probably recall, is now privately held.
And now to our market monitor who likes big cap U.S. stocks. He is John Traynor, Chief Investment Officer at People's United Bank's Wealth Management Division, which manages $5.5 billion. When he was on in January, he recommended Oracle, which is down about 11%, Express Scripts, which is off 2%, and Whole Foods, which has gotten clobbered. It's down about 32%. Welcome back. Nice to have you back, John.
Thank you, Sue. Thank you. Nice to be back.
Let's start, first of all, with whether you still hold those three stocks. And then secondly, what do you make of the risk on in this market this week?
Well, the first two that you mentioned, we still do own. We still like them. Whole Foods, we actually sold in the spring. We did not see the continuation of the good news that they had in the fall. The comp store sales started to fall off, so we decided to step aside. We have it on a watch. We may go back in, but we don't own that stock now. And when it comes to the risk on, as you asked, we've seen that so far this month. The stocks and the sectors that didn't perform well in the third quarter have been the leaders so far this month. So, for the first few days of this month, the risk on trade is working.
Let's get you to walk us through some of your picks this time around. You have three big blue chips beginning with Disney. Are you not concerned with something that a lot of investors have been as you see that fall off there in August, and that is cord cutting and maybe reduced fees for some of the cable properties?
Yeah, we use that fall off as a buying opportunity for Disney. And the big news with Disney, the company's doing very well, but the big news that investors focused on was really ESPN and the potential for cable companies for them to lose cable subscribers. But if you look at Disney, my clients, your viewers, they want to own what Disney produces. So there's a whole field of narrowcasting that we think the street is missing, that Disney will be able to deliver that content to many more individuals. So we think this is a great buying opportunity for Disney.
All right, Home Depot is next on the list with a price target over the next 12 months of $131 per share. Play on the housing market?
It is, and the real key here for your viewers is to focus on household formation. Since the end of the recession, formations through the end of 2014, household formations were running in the basically 500,000 to 600,000 per year. since the beginning of this year, they've been averaging over 1.6 million per year, which is fantastic. Those are all new formations. Those are all new home buyers, new condo buyers. So there's a tremendous pent-up demand for what Home Depot is selling. So we think they're really, the wind is at their back.
All right, let's move on to the third one, which is United Healthcare. How high, how soon, and why?
You know, we like United Healthcare for a couple of reasons. It's a major beneficiary of the Affordable Care Act, which everybody's aware of. But as the dominant player in the industry, some of their competitors are merging to be able to achieve the mass that United Healthcare has. They are driving cost containment as we move forward, and that's going to be a very positive story for them going forward. They're gaining new customers through increased insurance. So they're a real beneficiary of the Affordable Care Act.
All right, and the price target in the next 12 months is $129 per share. John, thank you very much. Have a great weekend.
Thank you. You
John
too.
Trainor with People's United Wealth Management.
Well, Sue, crude prices may have risen recently, but they are still well below year-ago levels, and many oil production companies have yet to feel the full effects of low prices. But as Morgan Brennan explains, that time may be near.
Risks are continuing to mount for energy companies. Many oil and gas producers are currently grappling with the possibility of shrinking credit from banks. But as 2015 comes to a close, another threat looms: a significant rollback in producers' ability to hedge commodity prices. According to a new report from market research firm IHS, just 11% of total North American production is hedged heading into 2016. Compared to nearly 30% right now.
The companies that are well hedged in 2016 will receive higher revenues and stronger cash flow as a benefit of the higher hedge prices that they've locked in. And this will give them more flexibility in determining their drilling plans and capital spending next year.
Hedging has been crucial for oil companies to weather the collapse in energy over the past year. The process allows producers to lock in on commodity prices in the futures market, a move that can protect against plunging prices. With crude nearly 50% lower than a year ago, hedging protections have been a saving grace for companies like Pioneer Natural Resources, which recently said it expects to realize $71 a barrel in its 2015 hedging program and $65 to $66 next year. The rollback in 2016 will leave companies, particularly those with higher debt levels, more exposed to market prices, leading to financial difficulty if oil stays lower for longer. IHS says smaller companies like XO Resources and Comstock Resources are at risk of serious liquidity issues, thanks to little hedging. Also mid-sized names like Sandridge Energy and Ultra Petroleum.
And here's why this matters so much. If energy prices remain this low, producers that aren't hedged could see revenues plunge further and access to credit dry up. Energy investment firm Tudor Pickering Holt expects the pullback in hedging to reduce cash flow for the overall industry by $10 billion next year, resulting in an additional 20% decline in capital expenditures, meaning less drilling, more layoffs, and for some poorly positioned energy companies, the growing threat of bankruptcy. For Nightly Business Report, I'm Morgan Brennan.
Coming up, a big change is happening in the healthcare industry, and if it all goes smoothly, it could lead to better care. Here's what to watch for next week. Earnings season gets underway with a handful of Dow components reporting. The Producer Price Index, retail sales, and industrial production are all due out, and the Nobel Prize in Economics will be announced. That's what to watch next week.
And I will not be winning it. Medical coding, it doesn't sound exciting, but it is an important part of our healthcare system. Determines who gets paid and how much in many cases. For every diagnosis and procedure, there's a code that describes it. And now there are thousands more of them, and any problems getting claims processed could disrupt this critical industry. Bertha Coombs reports from Watertown, Massachusetts.
They've been working round the clock at Athena Health since the October 1st launch of the nation's new medical coding and billing system known as ICD-10, making sure things go smoothly for their physician clients. CEO Jonathan Bush says in the first week more than 1 million claims were submitted, with fewer than 500 rejected for coding errors.
ICD-10, as you know, has been delayed a couple of times, so we've had fire drills before to get ready for this. So by the time it actually happened, it went off smoothly.
The transition was delayed for 2 years during the launch of the Affordable Care Act because it involves a major overhaul for the U.S. health IT system with a 5-fold increase to the nation's medical codes.
We now have up to 68,000 diagnosis codes and 76,000 procedure codes that we are required to report for billing and regulatory purposes.
The idea is that more detailed health data will lead to better care and eventually better health outcomes. But at hospitals like Montefiore New Rochelle outside New York City, the added complexity has meant months of retraining for everyone on staff. So far, it's paid off.
We have had no glitches.
But Surgeon Andrew Kleinman says the verdict is still out.
It's still a little bit early to see how the payment is going to be affected, which is the big thing that we are worried about.
Especially when it comes to his private practice.
In a hospital, it's great. We have a lot of backup. We have people who are running IT. In my office, I'm the chief of IT.
Jonathan Bush thinks it will take a few billing cycles to know just how well the system works.
You might want to check back in. It's between day kind of 30 and 45 when some of the slower, more manual payers are getting around to sending out their first payments.
Still, after the disastrous launch of the Healthcare.gov insurance exchange, health officials are likely breathing a sigh of relief for a smooth launch this time around. Bertha Coombs, Nightly Business Report, Boston.
And that does it for Nightly Business Report for tonight. I'm Sue Herrera. Have a great weekend, Ty.
And you too, Sue. I'm Tyler Matheson. Have a great weekend, everyone. And we will hope to see you right back here Monday evening.